Welcome to the Center for Energy Studies Friday Happy Hour. I am Michael Maher, Senior Program Advisor, and with me is
Anna Mikulska, a Fellow in Energy for Center of Energy Studies at Bacon Institute.
And we both hope you're all staying safe and healthy, and that you don't have to wear your face mask to look at this webinar today. We're going to be focusing today on challenges of the oil demand recovery in the post-COVID world. We are really in an unprecedented times, a unprecedented global economic shock with a resulting global demand shock to the oil sector. And I think one way to kind of start this off is to paraphrase Tolstoy. Happy economic times are all alike. Every recession is unhappy in its own way. And I think that's one of the things that we're going to be discussing today, that looking back in history can give us some ideas of what might happen, but nothing like this has ever happened before, and the recovery will not be like any of the recessions before. And so I think that's something to keep in mind as we discuss. And in some sense, you know, economic forecasts, oil forecasts are flying blind. If you see something going out for even for the entire year, no one knows when the economies are really going to start up again. No one knows if there's going to be a coronavirus rebound in the following months. So, you know, a lot of the economic models and energy demand models are not very good because there's so many unknowns, and this is so unlike coming out of other recessions. So, but it is interesting to look back at history to see how this might be different than previous recessions and oil demand shocks. And my career actually straddles all the economic shocks since 1978. I've lived through downturns in oil markets throughout much of the latter part of the 1900s, and then the 2008 recession in the United States, and now I'm living through this. And Anna, you can give a little background of, you know, your experience living through tough times.
Right, and actually, as I was thinking about this webinar and what we're gonna say, how we're gonna structure the webinar, it occurred to me that as unprecedented as this time is, I have lived through something that was similar. And it was when I was a small child. It was martial law. Poland introduced martial law that actually really limited people's movement. Also, there was a curfew imposed and limited economic activity and general activity, meetings, and so on. In many ways, very similar to what's happening now. Granted, I was a small child, so I don't remember much more than one night when I woke up at my grandma's and I really want to go back home, and my grandma couldn't walk me there because she would be arrested, as it was after the curfew. But what I remember really well is the crisis that followed. And that's where I think the similarities kind of diverge now, where the similarities end. Because the time where Poland went into the martial law, it was already in a crisis. The country was already in crisis. It was already in a recession. And after the martial law, the recession continued, potentially even greater. And the interest, and it, of course, it was central planned economy, and it wasn't able, the economy wasn't able to pick up afterwards. The state couldn't do that. And in fact, when the economy picked up was after 1989, when market opened, when people were allowed to, to trade, where they allowed to having their own businesses, where businesses privatized, where market institutions were able to work, which kind of going back to what's happening now is actually an encouraging element of that story, because starting off, we have gone into this recession or into this economic difficulty with a generally healthy economy, with healthy fundamentals. We don't know how long it's gonna take. We have no way of knowing, but the market institutions, the different types of infrastructures, precisely for energy, energy production, delivery, consumption, all that infrastructure exists. We don't have to reinvent it. And you know, that gives us a very good indication that we can recover much faster than Poland ever could in 1993 and going forward, in 1983 and going forward. So, Michael, let's talk about where economy is today. Kind of take it off, and yeah.
So, just a little background. These are a little bit more on the gee whiz side, but I think it kind of shows how unprecedented this is. Around the world, 4 billion people are under lockdown. That's half of the world's population. In the United States, 26 million people have filed for unemployment in the last 5 weeks. If you go back to the 2007 to 2009 job losses, they only totaled 9 million. JP Morgan said that the GDP is falling at an annual rate of 40% in the second quarter in the US. 45% drop in Europe, 59% drop in the UK, 35% drop in Japan. IMF is saying, well, you know, their best guess is that the globe is going to drop 3% this year. US economy will drop about 6% full year. But again, you know, those are forecasts looking at some type of rebound in the second half, which we're not sure, you know, when that might occur. IMF has mentioned that the Asia economic growth will grind to a halt for the first time in 60 years. China's growth is expected to be about 1% this year. You know, that's unprecedented for the last 15 or 20 years. In Europe, Italy's GDP could drop 9%, Greece 10%, Spain 8%. Again, that's assuming start of a normal recovery in the second half of the year. Now, there is one positive thing that's going on in the United States and somewhat in Europe, is that we are having an unprecedented stimulus. So far this year, $2.5 trillion worth of federal funds are being pushed into the economy. That's 3 times the amount during the 2008-2009 Obama stimulus. You know, that might help us get back on track. But again, those are all unknowns. We've never had a stimulus like that. So Anna, where are we today kind of with oil demand, given that economic outlook?
Right. So we all kind of know that if the economy is not doing well, we won't need as much energy. And particularly in this case, oil is hit because a lot of transportation is hit with the lockdown that Michael was talking about. And the current crisis has already had quite an impact, a drop in global oil demand of 26 million barrels per day, or over 25% in second quarter. US consumption fell by 1/3 since lockdown in March. That's huge. And the issue is that even though the prices are falling, because of the specific nature of current economic downturn, we cannot that those low prices cannot really push the demand. It doesn't matter how cheap the gas is at the gas station if you cannot travel anywhere or even cannot commute to work. So that's very, very important that we cannot, that the low prices that we see now, they won't incentivize demand. That being said, oil market is not the worst hit. And I think that's important to recognize. It's not the sector that's hit worse in the global lockdown. When we look at the airlines, some of them lost 90% of their business. In April, on April 22nd, 93,000 passengers passed through TSA checkpoints versus 2.2 million last year, 96% drop. In Europe, 9 out of 10 flights have been grounded. So that's a lot. National hotel occupancy plunged completely to unprecedented levels, with some hotels experiencing literally zero demand, almost zero demand. Car sales, we see very similar thing going on. And again, restaurants very much impacted. Tourism is pretty much non-existent now. So in Spain, in Valencia, the first largest city in Spain, hotel cancellations are 95%. And that's not the one city that is experiencing that. So yes, US oil and gas industry, oil industry everywhere has been impacted a lot, but it hasn't been impacted as many other sectors. And if one has to look at which of those sectors is used to those downturns, is the oil and gas industry. That's the one sector that not only has experienced the ups and downs, but knows how to pick itself and go forward and move forward from something that looks like a very big economic drop. And Michael knows a little bit about it, right?
So let's look back into history, back in the recession in the late 70s, early 80s. Their global oil demand dropped from the 70s peak and stayed below that. That was global oil demand, stayed below that for a decade or so. Oil prices stayed in the range of $10 to $20 a barrel for a decade or so. So that was a huge hit on the oil sector. But what was interesting about that is that demand drop over that long period of time was largely due to a structural change in the oil markets. The US put in CAFE standards, and within 10 years, between 1975 and 1985, new car miles per gallon, doubled. Light trucks, fuel efficiencies increased by about 70% for new trucks. Oil was driven out of the power sector, pretty much in the US and then worldwide. Those structural changes did not disappear once the economy started going up. And I think that's a thing to keep in mind, is to think when we get to today's recession, are there any structural changes? What really is driving the drop today versus what happened in the 1970s and 80s? And Anna, what about the recession in 2008 and 2009?
That's the one I remember quite well. Although having lived in Houston, I probably haven't experienced it as much as people that lived in other places, like in California. Part of it was because the US oil and gas sector was supporting the recovery during the post that recession, which we're gonna address soon, kind of talking about what's happening now. But what we've seen there is that growth in oil use has been really, the recovery has been brought by growth in international growth, growth in Asia. You had the unemployment first has become large, but then it fell thanks to development of in the US to a good extent oil and gas industry. We had experienced the shale revolution as at the very same time when we tried to get out of that recession. Oil consumption fell at the same time during the recession. And really, when you look at what's happened later on, it didn't recover. And so we are still in
That's in the United
2019.
States, right?
Right,
Yeah.
in 2019, we haven't been yet to the in terms of oil consumption to what we were in 2007.
But looking at global oil demand, which was pretty interesting during, you had a global recession. Coming out of that going in the middle of that global recession, you hit about 84 million barrels a day of oil demand. And that's the bottom. And by 2011, global oil consumption was up about 5 million barrels a day. And by 2015, it had risen by 10 million barrels a day above that bottom. What was really driving that? China's economics. The Chinese economy averaged 9.1% economic growth between 2008 and 2013. That was a real driver for the world economy to start coming back after that recession, but especially a big driver of oil demand. And in fact, if you look at the 10 years after the start of the global recession in 2008, in the developed world, what you call the OECD, consumption was still a little bit lower in 2018 than it was in 2008. In the non-OECD, oil demand grew 14 million barrels a day between 2008 and 2018. China was about 6 million barrels a day of that gain. So that demand driver was not a result of what was going on in the United States or Europe, and that's something to keep in mind as we look at coming out of this this current recession. Is that in 2008, 2009, you had a huge demand push, especially by Asia, and during that same period, oil prices bottomed out in 2009 around $61. But by the end of that period of 2013, prices were back to $110 a barrel. So you had this enormous demand growth with very high prices coming out of a recession. So now let's look at the current recession. How's that differ from what happened in 2008? Anna?
Yeah, this recession is different for many different reasons, right? So it's occurred faster. It seems to be much deeper. It's experienced by literally the whole world. The oil consumption fell drastically, very quickly. OECD lost approximately 1/3 of its demand. Non-OECD approximately 20% of oil demand for 2020. We project as projected. So it's really and the prices are not there. So even if we see that recovery going forward, we probably won't see $130 per barrel prices anymore, right? So that's something that has to be kept in mind. However, this is the big difference here is that this recession now isn't driven by economic downturn, by economic fundamentals not being there. It's driven by external factors. It's driven by COVID, and it's driven by governmental response to the pandemic and fear that the pandemic instilled in people. And that's why it's very difficult for us to apply any type of models that could have been applied to any other recession that we are thinking about, because there is nothing like this that we have lived before. And truly, until the limitations that are imposed by all pandemic, government regulation, and the fear that people experience, until those limitations are there, it's going to be very hard to push any type of economic recovery or demand, and I think that's where this uncertainty exists. Now, the longer it takes, the more we are likely to see that that economic fundamentals that have been generally there being weakened. Right, so we'll see, the more we see disappearance of jobs or greater unemployment, long-term unemployment as a leftover of that economic of the lockdown, basically, of half of world's population. And I think that's what needs to be underscored. We do not know how long those limitations that are outside of any type of economic predictions or any type of economic tools that usually are used for economic recovery to happen. Until this, we really are not able to know how we can recover and how fast we can recover and how we can come out of the recession.
So if you looked at, well, what's going to get us out of this recession, what's going to drive U.S. oil demand back up? If you look at autos and light trucks, it's getting people back to commuting, back to their normal driving. The challenge there is the high levels of unemployment, which means that miles driven is probably not going to return for a while. But unlike the 1980s drop in U.S. oil demand, on the auto side, this demand is really related to economic activity, not because there's some structural efficiency change like a new CAFE standards. And so to date, it's really how fast the economy can recover is going to impact driving of passenger cars and light trucks. The diesel transportation, again, is also going to be tied to the economic recovery. And to date, diesel drop in demand is nowhere near as large as gasoline because there's still being shipments of goods. And again, as the economy recovers, diesel should recover. There is one sector, though, that is going to really be hit and continue to be hit most likely, and that is the jet fuel sector. Is there a structural change there as Zoom really cut back on future business travel? Are individuals' fears of COVID returning, meaning they're not going to fly, they're not going to go overseas, they're going to stay close to home? So that's the airline sector is going to be a very interesting thing to watch, because that may take a long time to come back compared to other recessions. The industrial sector, again, it's kind of tied to the economic recovery. As the economy comes back, whatever is being used in the industrial sector should return. But I think it's also important to remember that, after the 2008, 2009 downturn, U.S. oil demand, even a decade later, was still below what it was before that recession. So I wouldn't be surprised to see U.S. oil demand stay below the levels reached in 2019, that stay below those levels for quite a number of years. Anna, what about on the global oil demand side?
Right. So we've talked about how important Asia has been, and China in particular, for 2008, 2009. The world going out of the recession. That's when it was China was building in infrastructure, manufacturing was going along. You had very high economic growth, so a lot of demand for energy in general. This probably won't be the case as much, and I think I've seen there's a question about China driving demand, whether China will drive demand in a potential recovery. And I think, yes, it will, but probably not to the extent it has earlier. And part of it is also because China has become more reliant on external factors like exports. So while in 2008, 2009, this hasn't been yet the case as to the same extent, today, a lot of manufacturing that China is, what China produces is going to other places in the world. And if they don't recover, well, that also will kind of ricochet and impact negatively China. But I think it is one of the largest economies. It is going to grow.
So, Anna, one thing to remember too is that will China, the question was, will China drive us? Well, China might help drive us back towards previous levels, but remember in the 2008 and 2009, China drove us way beyond the recession levels.
Right.
And that's probably not going to happen, even if they start returning towards their, more pre-recession levels. That growth factor, that huge demand growth that you saw in China in 2008, 2009 is not going to come back in this time period.
Right. And then as we were looking, even before the pandemic, when we were looking, remember together with, we were writing the article on what's going to drive demand. China will be important factor, but it's the other countries in Asia too, Southeast Asia, general, India. We also have to look at those countries, and it's going to be concerted effort. It's the demand is going to come from the developing world more than it will come from the developed world. I think I'm not sure whether we can repeat what happened in 2008, 2009 with this really, really high rate of growth in a huge economy. That this time it will be more of a concerted effort, I believe.
One interesting thing is in the United States, new car sales really don't drive demand much in the United States. The U.S. is pretty much saturated with cars per person. New cars may replace old cars and have an incremental benefit because they may be a little bit more efficient. But in the rest of the world, a lot of that demand growth is because people are buying automobiles for the first time. And so you're increasing the number of automobiles per person in those countries, and their income really drives that. And so if the economic growth is slow for a number of years, that's going to slow down car buying in those countries, which will also slow down oil demand.
Right. And on the other hand, I think particularly in the developed world, you might end up with slowdown in new car buying, which could increase demand for gas because more people will use less efficient cars, or fewer people will be able to afford electric vehicles that are this big ticket item that maybe otherwise they could buy. So there is a lot of very interesting factors that and very interesting details that kind of the situation fleshes out. Yeah. How about for U.S. oil sector, Michael?
Well, yeah, I'm going to play the economist here.
Please.
Price elasticity, if you look at that for oil, with oil prices this low, you would think that would have start to have a pretty big impact on demand. However, people need to remember that price elasticity is stated in terms of everything else being equal. And in this current recession, the economic growth impacts, or the loss in economic activity, the unemployment, that is swamping any small positive from the price elasticity. Another way that what's interesting about this potential recovery is again in the 80s, the drop in U.S. oil demand was driven by efficiency improvements and substitutions in power. Right now, that's not likely to be is not going to be a major factor. With the drop in income and wealth, some of those Teslas are probably not going to be purchased. The efficiency changes in the next few years is probably going to be small in the United States. Another thing is fuel switching. Again, back in the 70s, a lot of that fuel switching was pushing out oil in the power sector around the world. Right now, this drop in oil is not really driven by a substitution or efficiency gain. Again, it's driven by a lack of economic activity. And so in that sense, if the economy recovers in the world, in the United States, you'll start seeing oil demand rising again, back towards its normal levels. The question again is, how fast does the economy recover? Is it a year? Is it 2? Is it 3? But again, I think oil demand is really going to be driven by economic growth around the world as you look out the next 3 to 5 years.
Right. We have a question here, which actually we didn't address when we had it. I think we were talking about it before. No mention of working at home and less commuting because of that. Certainly the air is cleaner, and maybe this is a part of the new normal. And we've talked about it, Michael.
Yeah, I mean, I think you'll, for example, the Zooming will likely reduce business travel some in the recovery. How long that will continue, but I think because people's risk perceptions and businesses' risk perceptions, not knowing whether coronavirus may come back again in the fall or the winter, they're going to be reluctant to fly, and we'll probably still continue to use Zoom somewhat. I think there may be a little bit more telecommuting, but I think most people are dying to get out of their homes and go to the office or go back to work. The loss of socialization, that I don't think that's going to be as big of a deal as it might be for air travel.
Yeah, I think, although I think there will be some move to increase in telecommuting. I think some companies will figure which jobs lend themselves better to that than others. But what we also have talked about the fact that unemployment can actually cut on the commuting part, and that's what could be at least in short term. Again, I think there is a lot of uncertainty, and there is a lot of very difficult things to kind of to interpret. But I don't think it's all negative. There is a lot of, and we've had a question here about lots of negative signals, but anything positive on the horizon, and what's the best case scenario? What signposts should we have in mind? I think one thing that we've underscored is that we started getting into this recession from a very different start point. Our economy has been quite healthy, and that hopefully will help us recover faster. Michael?
And the huge stimulus that's out there, maybe that is a positive drive. I think the most positive thing would be the global lockdown ends in the summer, early summer. Things start returning. Coronavirus does not spike up again, and so this is a moment, a 5-6 month drop, but then things start going back. But I don't have any expertise on whether the coronavirus is going to spike back up again. I think that's a big unknown, and I don't know how fast the entire world is going to return from lockdown. It could still be that it's really hitting the poorer nations as the United States and Europe starts going back to work. So you start shutting down some of the smaller Asian economies, Latin America. So I guess that's still the biggest concern is when does the lockdown end, and is there a second wave of coronavirus that may lead to at least some lockdown, in the fall or the winter. So.
And I think, to a good extent, governments have a big role here. And it's definitely not the central economy type of role that I talked about, kind of opening the discussion. It's one that gives people more certainty and relieves them from the fear, gives them a little bit more, trust in what governments are doing, that when they say it's safe to go or do something, they actually can do that. And that's a very important part of the solution. Because if we don't have it, then even if there is no regulation to stay at home, people will still limit their activities. They will limit getting on the plane, right? They will try to work from home. They will keep their kids in the summer at home as opposed to sending them to camps and so on and so on.
There's been evidence in China of a big drop in inner city bus use and more driving between cities and individual automobiles. Again, that's a fear of being in close quarters with other people. I do want to go back to the Zoom thing just a minute, which will be very interesting. Is will companies find that productivity dropped because you weren't meeting in person, or will they find that productivity didn't change? I mean, I think that we really have a big test here for companies to try to determine, what the impact of working from home might be. So, I mean, I think that'll be an interesting thing. At least there'll be data to see, for companies to see whether, a big drop in their employees from telecommuting.
Right. Let me check other questions that we're getting. There's quite a lot of them. So let's maybe go back to our that paper that on the future of demand. That was our long-term view on what's going to drive the demand for oil and gas as opposed to short-run factors. So have these views changed? That's one of the questions regarding the long run. Has that coronavirus changed anything in what we were saying?
Well, I think again, how fast does the non-OECD world, the developing world, China, how fast do they return? Because those are the real drivers for oil demand. I think the other thing out there that you'll have to watch is, did this pandemic and economic stress push forward climate change policies or retard them? In the United States, the Democrats have been pushing for the next round of stimulus to have quite a bit for renewables, electric cars. One of the challenges is the U.S. now has an enormous fiscal deficit, unprecedented, way beyond anything we've seen in it may even be more than during World War II. And with lower tax revenues coming in because of slower recovery too, that's a question. Is there a stomach for going into even more debt? Around the world, if you go to China and India and those countries, again, sometimes environmental investment is easier to do in good times than in bad times. And so are they going to be pushing as much for renewables? That's a question going out there. I think the last issue about that would be this pandemic has not been a glowing international response. It's been a lot of countries on their own, for themselves, by themselves. Doesn't bode well for the type of coordination and sharing that a global climate pact is going to require if it's to be successful. So,
and we've talked about, Michael, about how there is a need of not only focusing on what the developed world thinks we should be doing in terms of energy demand, but also what on the developing world can be doing and how the developed world can help. And I think that's one question that we will be looking at is there a more concerted effort, particularly when the developed world is very much now challenged by this pandemic, to an extent even more than the developing world, and not in terms of monetary, but the public, the more wealthy public often demands much more from the governments in the US, in Europe, than the public in less affluent country that is used to the fact that government might not be as effective, for example. So I think that's going to be another challenge that will have to be addressed. Another thing I think we didn't kind of underscored possibly enough, is the fact that as the world recovers, we might how will the energy demand recover? Will this be a U-shaped or V-shaped recovery? Is it gonna recover quickly, just like in the and then follow past recoveries? I think one thing are the limitations gone? And the other thing that Michael has already alluded to is the fact that now with a lot of oil and gas coming, basically being stored increasingly, there will be an amount of energy that's stored already, and there's gonna be supplying the economies for a while before the prices can rebound. Or to an extent, if all the limitations are gone, it can help economies recover, because then the oil and gas are gonna be cheap and economies can grow faster. But again, it's that uncertainty that none of us now can say, and Michael has been talking about it. We don't know how long we will have to be in the lockdown. We don't know whether we will have the pandemic coming back once again, and that's what's going to be that uncertainty is definitely the main certainty here.
Well, I do think the overhang of inventories of oil, it's going to take a long time to work off. And I do think it's, if I was looking at the upstream sector in the United States on the oil side, it's going to take a long time. I would guess a number of years before we would ever start getting back to the levels that we saw right before the recession. I think the global economic growth is going to be slower. The overhang of oil, the low prices are going to discourage capital from coming in for a while. So right. I'm not wildly optimistic that the oil sector is suddenly going to be the upstream sector is going to be doing well.
Yeah, I think it will take time and effort, but as we pointed before, this is the sector that knows how to rebound. So I'm thinking it's prepared for kind of getting back into business, and it might end up with some bankruptcies, consolidations, but also technological advancement to lower the cost, to make to introduce new types of energy or carbon capture and storage issues and so on. So we have to wait and see. I think at this moment we probably are running out of time. There's a lot of questions that we weren't able to answer. However, we will
do one more. Why don't we do one more question?
Sure, one more question. Okay. Oh my goodness, there's, as I said, there is so many of those questions. Can you address the effect of reduced E&P capital investment and shut-ins on supply, and whether we could face a supply-demand imbalance in the other direction in 5 years or so? Michael.
Well, that's one of those unknowns, is how fast does demand come back? And how much do you need supply to start ramping up again? I do think it's important to remember, at least in the shale world, all that shale resources, we know where they are. They haven't disappeared. If things start getting tight and prices start coming back, shale is some of the fastest to come back. Much easier to ramp up shale drilling in the United States than it is to suddenly say, well, I want to start investing in deep water offshore someplace, which may take 5 to 7 years of pre-planning and construction before you can even get any production out. So I don't think we're going to see an extended period of a shortage anytime soon. And that's also given that Saudi Arabia has announced their intention to be able to produce 13 million barrels a day. So as demand starts recovering, they're going to want to capture some of that demand too. So I don't see a lot of factors right now saying that we're going to be tight in oil in 4 or 5 years. But again, we're coming out of we're still in an unprecedented recession. How does that play out is going to determine, oil demand growth and then investment in oil.
Right. And again, we're holding those webinars, the happy hour webinars, every Friday at 3 p.m. Central Time. So please tune in. We will be talking about gas and LNG next week. So please make sure you register, you tune in, and if we weren't able to answer your questions, apologize. The time is it would take a very long time. We have quite a lot of those. Please reach out to us also over an email. They are available on the website. We are happy always to exchange the ideas. As such, please take care of yourself, stay safe and healthy, and we hope to see you next week.
And as this is a happy hour, make sure you're happy for another 15 minutes or so, and treat yourself to a treat. We'll see you next week.
Next week.
Bye.
Bye.